Hey there, and welcome. If you're running your own childcare business, you already know how incredibly rewarding it is, but you probably also know how, well, confusing the whole business side of things can be, especially when it comes to taxes. So, in this explainer, we're going to slice right through all that confusion. We're going to give you a super clear, really practical guide to help you handle your finances and your taxes like a pro. So, let's jump right in. You know, it's probably one of the biggest hurdles in your line of work. Your home is your business. Your groceries can be a business expense. Even your family car might pull double duty. These mixed-use expenses are everywhere, and trying to figure out what you can actually claim and how to do it right can feel, well, pretty overwhelming. Our whole goal today is to bring you some clarity and give you a rock-solid plan.
Okay, so here's our roadmap for today. And just a quick heads up, the specific programs we'll talk about are based on Canadian tax law, but honestly, the main ideas are super useful for providers just about anywhere. We're going to kick things off with the absolute basics. Then we'll tackle the big one, the home deduction. After that, we'll get into daily expenses, big-ticket purchases, and even some really smart strategies to boost your family's finances. And to wrap it all up, we'll talk about how you can help out your clients. So let's start building that road to tax confidence one step at a time.
All right, first things first, let's build a strong foundation. Before we even dream about deductions and all that fun stuff, we have got to get these core habits right. I promise you, if you nail this part, everything else we talk about today is going to be so much easier. Now, if you only take one single thing away from this entire explainer, please let it be this. Keeping meticulous, detailed records is completely non-negotiable. This is the most important habit for anyone who's self-employed, but for you, it's absolutely critical. Just think of your records as your proof, your backup, your everything. So what does that actually look like? Well, first, you got to track every single dollar that comes in. Doesn't matter if it's from parents or a government grant, you track it. Second, and this is a game changer, open a separate bank account just for your business. This is so important. It creates a nice, clean line between your personal life and your business life, making everything a breeze to follow. And third, from the second you decide you're open for business, save every single receipt for anything you buy for that daycare. And now for the big one. The question we get asked more than any other is about deducting expenses when your business is literally your home. This is where those great records we just talked about meet a very specific formula to unlock what could be your biggest deduction. This quote just says it all, doesn't it? Unlike a separate office, your workspace is also your living room, your kitchen, your backyard. So you can't just go and deduct 100% of your rent. But the good news is, there's a specific formula made for exactly this situation, and we're going to break it down together right now. Okay, I know what you're thinking. A formula looks a little scary, right? But trust me, it's actually really logical when you break it down. It all boils down to two simple ideas: the amount of space you use for your business and the amount of time you use that space. That's it. You just take your total home expenses and multiply them by a space percentage and a time percentage. Okay, so that's the theory. But theory doesn't really help you file your taxes, does it? So let's put this formula into action and see what it looks like with some actual real-world numbers. Here's how you do it in 3 simple steps. First up, the space ratio. You're going to measure the square footage of all the areas you use for the daycare, the playroom, the kitchen, the bathrooms, and divide that by your home's total square footage. Second, the time ratio. Add up every single hour your daycare was open for the whole year. Then, divide that number by 8,760. That's how many hours are in a year. And finally, you just multiply your total home expenses by both of those little numbers. Let's make it even more real. Let's say your total home expenses, we're talking rent, utilities, insurance, property taxes, the whole shebang, came out to $24,000 for the year. And let's say your daycare uses 1,200 square feet of your 1,600 square foot home. Okay, so that's a space ratio of 75%. Now, you were open for 2,600 hours that year, which gives you a time ratio of about 30%. So you multiply that $24,000 by 0.75, then by 0.30, and boom, you get a deductible home workspace expense of $5,400. See? Not so bad. Now, there's one very important rule you have to remember here. Your claim for these home workspace costs can't be used to create a business loss or make one bigger. Think of it this way. This deduction is awesome for bringing your business profit down, even all the way to zero, but it can't push you into the negative to create a loss that you could use against other income. So now that we've tackled the absolute biggest deduction, your home, let's zoom in a bit on all those smaller everyday expenses. They might not seem like a big deal on their own, but believe me, they add up to some serious savings.
Honestly, the list of things you can potentially deduct is huge. Think about everything you buy just to care for the kids. The food, the toys, all the art and craft supplies, diapers, books, you name it. But it also includes the costs of just running the business. Things like advertising, bank fees, business insurance, and even any training courses you take to improve your skills. And don't forget field trips, like admission to a park or a museum. All of those? Yep, legitimate business expenses.
You know, food is the perfect example of why those meticulous records we talked about are your best friend. If you do a separate shopping trip just for the daycare kids, life is simple. You can deduct the entire bill. But let's be real, you're probably buying groceries for your family and the business all at once. In that case, you just have to keep a little log of which food was for the kids and then figure out the business portion of that grocery bill.
So we've covered daily stuff, but what about the big-ticket items? Things like a new playground set, or a computer, or new furniture. You don't deduct those all at once in the year you buy them. Instead, the tax rules have you spread out the deduction for that item's cost over several years. This whole process of deducting a little bit each year, it's called capital cost allowance, or CCA for short. So what kind of things fall into this category? Well, for a child care provider, the main ones are going to be furniture. Think cribs, tables, that kind of thing. Office equipment, like a computer you use for your paperwork, and even a vehicle if you're using it for the business. So, for example, if you bought a playground set for $1,000, you wouldn't deduct the full grand this year. Instead, you deduct a percentage of its value each year over time.
Okay, now that we've got the nuts and bolts down, let's talk about thinking bigger picture. Because being smart with your deductions isn't just about saving a few bucks on this year's tax bill. It can actually create a ripple effect that helps your family's entire financial situation in some pretty cool ways.
Check out how this amazing chain reaction can work. It all starts with your net income. So after all your deductions, let's say your net income is pretty low. Now, if you make a contribution to an RRSP, that pushes your net income even lower. This might drop you below the magic number where your spouse can now claim the spousal tax credit, which saves them money. And since your total family income is now lower, you might even qualify for bigger child tax benefits. See, one smart move can set off a whole bunch of good things.
So, what do you do with all this money you've saved? Well, think of it as fuel for your other big financial goals. You could use those tax savings to start making contributions to the Canada Pension Plan, which is so important for you as a self-employed person. Or you could use it to beef up a tax-free savings account or buy an insurance policy to protect your family. Put that money to work for you.
And finally, let's finish up with a simple but really important professional touch. Because managing your taxes well isn't just about you, it's also about giving the parents you work with the right paperwork that they need for their taxes. Here's a total pro tip for you. When you give parents their year-end receipts, don't just write down one big total. Instead, break it down. Show them the amount they paid for any kids under the age of 7 and the amount they paid for kids over 6. Why? Because parents can claim a higher deduction for younger children. And by giving them this breakdown, you're making their life so much easier. It's a tiny detail that makes a huge difference and shows you're not just a caregiver, you're a true professional.
Wow. Okay, we have covered a ton of ground today, from the absolute necessity of good record keeping to the nitty-gritty formulas for deductions and the smart strategies that can help your whole family. This information is powerful, but only if you use it. So what's your first step going to be? Are you going to go open that separate bank account, or maybe measure your workspace, or start a brand new system for your food receipts? Your journey to feeling confident about your taxes starts right now.